Today we're going to look at the company Enghouse Systems Limited, headquartered in Canada and traded on Toronto Stock Exchange under the ticker ENGH. Please stay tuned for the important disclosure information at the conclusion of this video. Enghouse Systems Limited was established in November 1984 in Markham, Ontario, by a team of software engineers led by Stephen Sadler. Initially focused on providing off-the-shelf enterprise communications software, the company aimed to help businesses manage mission-critical operations without the need for expensive custom development. This foundational vision proved successful, allowing Enghouse to build a stable revenue base from early contracts in the Canadian and U.S. public and private sectors. To fuel its ambitions for international expansion, the company transitioned to a public entity and listed on the Toronto Stock Exchange under the symbol ENGH. This listing provided the necessary capital to launch a highly disciplined, buy-and-hold acquisition strategy that remains the company's hallmark today. Under the long-term leadership of Sadler, who became chairman and CEO in 2000, Enghouse transformed from a niche provider into a global software consolidator. Over the decades, the company organized its diverse portfolio into two primary segments: the Interactive Management Group, focusing on customer engagement and contact centers, and the Asset Management Group, which provides infrastructure solutions for telecommunications and utilities. Major strategic shifts occurred as Enghouse adapted to digital transformation, significantly expanding its video collaboration capabilities through acquisitions like Video and Dialogic in 2019 and 2020. Most recently, the company has pivoted toward a cloud-first SaaS model and integrated artificial intelligence into its suites to meet modern enterprise demands, all while maintaining a debt-free balance sheet. Enghouse Systems Limited operates a diversified business model centered on the development and acquisition of mission-critical enterprise software solutions. The company's strategy is built around providing reliable, vertically focused applications that serve stable B2B markets, primarily through two main operating segments: the Interactive Management Group and the Asset Management Group. The Interactive Management Group is the larger of the two, focusing on customer engagement and visual computing. Its primary customers include financial services, healthcare providers, and technology firms that require sophisticated contact center platforms, video collaboration tools, and AI-driven customer service solutions. This segment enables organizations to manage complex omni-channel communications across voice, email, and video. The Asset Management Group provides specialized infrastructure and operational software for highly regulated industries. Its client base consists of telecommunications carriers, cable operators, utilities, and public safety organizations. These customers rely on Enghouse for network infrastructure, fleet management, and next-generation mobile network solutions driven by 5G and IoT technologies. Internationally, Enghouse maintains a significant global footprint with a primary revenue concentration in North America, followed by strong market positions in Europe, Scandinavia, and the United Kingdom. The business model is increasingly transitioning toward a software-as-a-service and subscription framework, with recurring revenue now accounting for approximately 70% of total income. This shift provides financial predictability while supporting a robust buy-and-hold acquisition strategy funded entirely by internal cash flow. The financial trajectory of Enghouse Systems over the last 2 decades reflects a masterful execution of a buy-and-build strategy, transforming from a niche developer into a global software powerhouse. In the early part of this 20-year window, specifically around 2006, the company was primarily focused on its GIS and telecommunications network solutions, generating modest annual revenues of approximately $63 million. As the decade progressed, management aggressively pivoted toward the contact center market, which birthed the Interactive Management Group. This division eventually became the dominant revenue engine, fueled by the rising corporate demand for omni-channel customer communication tools. By the mid-2010s, the company had successfully balanced its portfolio by formalizing the Asset Management Group, which catered to high-reliability sectors like public safety, transit, and utilities. The period between 2013 and 2019 saw a remarkable acceleration in top-line growth, with total revenues nearly tripling from $180 million to $386 million. This expansion was not merely organic. It was the result of absorbing dozens of smaller, profitable software firms and integrating them into Enghouse disciplined operational framework. A pivotal moment occurred in 2020 when the global pandemic spiked demand for video collaboration, pushing revenues past the $500 million milestone for the first time. In the most recent 5-year cycle, the narrative has shifted toward the quality of earnings rather than just raw volume. Enghouse has undergone a significant transition from traditional upfront software licenses to a SaaS-first and subscription-based model. By fiscal 2025, recurring revenue, comprising SaaS and maintenance services, accounted for roughly 70% of total income, providing an unprecedented level of financial predictability. Despite the broader market volatility and the sunsetting of legacy license sales, the company reported steady 2025 revenues of $499 million, maintaining a debt-free balance sheet that remains primed for the next generation of AI-driven acquisitions. This detailed financial breakdown explores the reconciliation of Enghouse Systems' annual revenue to its operating cash flow from 2006 to 2025. The data illustrates a resilient business model that maintains consistent cash generation even as the company navigates the complex transition from high-margin upfront software licenses to a more predictable, yet cost-intensive, SaaS and subscription framework. Tracing the company's evolution through the mid-2000s reveals a lean organization that successfully scaled through disciplined acquisitions. The early period, 2006 to 2010, established the buy and hold foundation, where general and administrative expenses were kept remarkably low relative to revenue. As the portfolio grew in complexity, moving from niche GIS solutions to global contact center and transportation infrastructure, expenditures in sales and marketing and research and development naturally climbed to sustain competitive advantages. A defining characteristic of Enghouse financial health is its net zero debt position, allowing the company to fund these rising operational costs and substantial dividends entirely through its organic cash flow. A critical nuance in this reconciliation is the role of working capital and contract liabilities. Because Enghouse often collects service fees upfront for multi-year maintenance or SaaS contracts, its contract liabilities frequently act as a significant cash tailwind. This allows the company to report operating cash flow that often exceeds its net income, providing a liquid war chest for rapid-fire acquisitions without the need for external borrowing. Even in 2020, during the unprecedented spike in demand for its video collaboration tools, and through the 2024 to 2025 period of stabilizing revenue, the company maintained a high free cash flow conversion rate. The final metrics demonstrate that while stock-based compensation remains a standard part of executive incentives, the core cash-generating power of the business remains robust, leaving ample room for shareholder returns. This capital allocation table reveals a company that operates with extreme financial discipline, adhering to a fortress balance sheet strategy for over 2 decades. The most striking feature of Enghouse history is the interest-bearing debt row, which has remained at zero for the vast majority of its public life. Unlike many software aggregators that rely on high-interest loans to fund expansion, Enghouse utilizes its own generated cash to acquire competitors. The company's dividend policy has been a hallmark of its shareholder value proposition, with 18 consecutive years of annual increases. A notable anomaly occurs in 2021, where the dividend payment spiked to $115.7 million due to a significant special dividend. This was a strategic move to return excess cash to shareholders following the unprecedented revenue windfall from the video acquisition during the early pandemic. Strategic acquisitions remain the primary use of capital. You will notice that in years where acquisition spending is high, such as 2023 at $56 million, the cash balance may temporarily dip or plateau, only to be replenished quickly by the company's high-margin recurring revenue streams. The free cash flow minus stock-based compensation metric consistently covers both the dividend and smaller acquisitions, demonstrating that the company's growth is truly self-sustaining. Enghouse Systems Limited is guided by a stable and highly experienced leadership team, headlined by its long-standing chairman and CEO, Stephen Sadler. Sadler is a veteran of the Canadian technology sector, widely respected for his previous role in turning around JC Computer Corporation. He joined Enghouse on April 1, 2000, and has since steered the company through dozens of successful buy and hold acquisitions. For the fiscal year ending October 2025, his executive compensation remained closely aligned with company performance. He earned a base salary of approximately 0.8 million Canadian dollars, with a total compensation package valued at 5.5 million Canadian dollars when factoring in non-salary incentives and equity. The company's ownership structure reflects a healthy balance between institutional confidence and significant insider alignment. As of early 2025, institutional investors hold the largest portion of the company at roughly 55%, with major holders including entities like FMR LLC and Fidelity International. Individual insiders maintain a substantial stake of approximately 20%, ensuring that management's interests remain tied to shareholder value. Steven Sadler himself remains the largest individual shareholder, directly owning approximately 11.5% of the outstanding shares. The remaining 25% of the company is held by the general public, providing a diverse and active retail investor base. The company has no long-term debt and a significant cash and short-term investments. The liquidation value is estimated at $91 million, or $1.73 per share. Let's build a scenario-based dividend discount model. The long-term outlook for Enghouse Systems Limited involves navigating a complex transition from legacy maintenance to high-growth, AI-enabled SaaS solutions while maintaining its hallmark financial discipline. The company is currently pivoting its strategy to emphasize share buybacks and targeted acquisitions over aggressive dividend hikes, reflecting a belief that its own stock is currently undervalued relative to external acquisition targets. The bull case envisions an acceleration driven by a SaaS-apocalypse rebound, where Enghouse emerges as a dominant consolidator of distressed, high-quality enterprise software firms. In this story, the company's buy and hold philosophy allows it to achieve an 8% revenue CAGR by successfully cross-selling AI biometrics and smart city infrastructure tools to its global client base. Capital allocation shifts aggressively toward share repurchases during the first decade, significantly boosting EPS. Operating cash flow margins expand toward 30% as synergies from recent European and Latin American acquisitions fully materialize. In the base case, Enghouse successfully stabilizes its interactive management group as the churn from legacy video business subsides. By integrating practical, paid-for AI consulting and small language models into its existing suites, the company maintains a steady revenue CAGR of roughly 4.5%. In this scenario, the asset management group continues to benefit from the $1.5 trillion mobility as a service trend through 2030, and operating margins remain resilient at approximately 26%. The company continues its 18-year streak of dividend increases, albeit at a more conservative pace of 5% annually, while pursuing opportunistic acquisitions to fuel inorganic growth. Conversely, the bear case considers a future where AI disruption causes faster than anticipated erosion of traditional contact center and enterprise software markets. If the transition to cloud-native models proves too costly, or if churn in the IMG segment outpaces new SaaS bookings, revenue growth could stagnate at a 1% CAGR. In this defensive scenario, Enghouse would likely prioritize its fortress balance sheet, slowing acquisition spending and capping dividend growth to preserve its $270 million cash pile. While the company would remain debt-free, the lack of a high-growth engine could lead to a lower valuation multiple over the long term. In the bull case scenario, we assume the following: revenue growth at 8%, operating cash flow margin at 30%, capex growth at 4%, stock-based comp growth at 6%, dividends growth at 10%, stock repurchase at 8%, acquisition spending in the next 20 years at $1.8 billion. Stock repurchases assumes price-to-sales ratio of 2.5. With this discounted at 7.5%, dividend model yields $33 worth of value per share in 20 years, $61 in 30 years, and $100 in 40 years. In the base case scenario, we assume the following: revenue growth at 4.5%, operating cash flow margin at 26%, capex growth at 2%, stock-based comp growth at 4%, dividends growth at 5%, stock repurchase growth at 2.5%, acquisition spending in the next 20 years at $1.1 billion. Stock repurchases assumes price-to-sales ratio of 2.5. With this discounted at 7.5%, dividend model yields $20 worth of value per share in 20 years, $28 in 30 years, and $34 in 40 years. In the bear case scenario, we assume the following: revenue growth at 1%, operating cash flow margin at 22%, capex growth at 0.5%, stock-based comp growth at 2%, dividends growth at 1%, stock repurchase growth at 0.5%, acquisition spending in the next 20 years at $0.6 billion. Stock repurchases assumes price-to-sales ratio of 2.5. With this discounted at 7.5%, dividend model yields $14 worth of value per share in 20 years, $17 in 30 years, and $19 in 40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.